Hello, this is Dale. Today, in today's video, I want to talk about a common question that retail investors have, and also one of the big reasons that retail investors lose in the marketplace, and that's not having a proper trade size for their portfolio. And in this case, I'm going to be focusing directly on a credit spread portfolio. However, this is true for any portfolio, and the equations I'm going to show you can be used for any portfolio size you have. I want to specifically look at credit spreads. Again, my name is Dale Brethauer. I've been a trader for a long time, hedge fund manager, and I am the founder and the option coach. We specialize in credit spreads at www.optionsinfinity. Two of the big products we have is once every 2 weeks, I give a webinar. I teach the webinar. We go over all the trades that I have made. And the second thing is, when I make a trade, before I put it in, I send an alert to all my members so that you can earn while you're learning how to do credit spreads the right way. One of the biggest reasons traders fail is they invest too much on any given trade. Professionals realize that losers are inevitable, and even losing streaks are inevitable. And this took me a while to realize and embrace losing as part of the system. Nobody's going to be 100% right all the time. As a matter of fact, some of the big boys in this industry, the Warren Buffetts and the Peter Lynch's, all talk about if you can be right about 60% of the time, you can kill it. You can kill it. But you are going to have losers. You want to cut them short, and you're going to have loser streaks. You want to keep them short. And if you have a good strategy, you just want to execute, and that's what I teach. And I think it's the very best way to bring in consistent money from the stock market, and to make sure that you never overinvest, but you invest the same amount on each trade. A lot of people say, well, which trades are going to be the good ones? I have no idea. I have an entry strategy which I teach, but when I get into a trade, I don't know whether it's going to end up being a good one or a bad one. I do know that as soon as I get into a trade, I know when I'm going to exit, and that's the key. That's the key. Let's take a look at this group of formulas that I put together. And let's just assume that you're starting out, you have a $10,000 portfolio, you want to trade in credit spreads. Professionals would like to risk only 1% per trade. Well, 1% of 10,000 is $100. You look at that and say, well, I can't make much money with that. But that's the amount you're going to risk, okay? And I know that my average loss on any given trade, sometimes it's going to be more, sometimes it's going to be less, but the average loss is going to be 6% of margin. Now, most of the margin for a credit spread is going to be, and I'm usually looking at a 10-point spread, so it's 10 times 100 shares per contract, or $1,000 per contract margin required. I'm looking at the average loss of 6% of that. It's about $60. So 1 or 2 contracts per alert is going to be about 120, 60, between 60 and $120. It's well within your range here, okay? And let's say you're looking at 10 trades. You've got 10 alerts that you're following. 10 trades times the $1,000 per margin is $10,000, and that's what you got in your portfolio. So you're good to go with everything at that trade size. Now, the potential return on that, and of course, past performance is no guarantee of future results, is going to be about $375 per month. One contract per alert, it's about 4% a month, consistently, year after year after year after year. Okay. Want to go over the risk profile? I've shown you this before, and this is how, one of the ways I look at managing the trade, when to get in, when to get out, when to get out. And this is the green line is what the credit spread will be worth at expiration. A lot of people look at this and they say, well, the risk is a lot more than the return. That is correct. However, we trade, this purple line is the daily figure, and I trade managing the trade based on this purple line. I put in this dash line, and this is actually 6% loss. Okay, this is the break-even point. So when the trade gets to 6%, this is kind of my uncle point, if you will. This is the point that I don't want to go much beyond this. Okay, and this is how I manage the trade. This, in conjunction with looking at support and resistance, looking at the 5-day crossing the 8-day, are what I use to exit the trade. On the other side, I'm looking for it to gain about 10% of margin, and that's going to be very close to the maximum we can get here. And a lot of times I'll get that in, I'll put on a trade, a leap trade for 100 days till expiration, and in 4 or 5 days I've reached this goal, and I'm out. I'm not going to stick around and just get that little bit more of profit. You need to have realistic expectations. This is what I teach is a rock solid strategy. Taking a look at trading account size, again, a small trading account of $10,000, $1,000 for monthlies and leaps, 500 for weeklies, because I only look at a 5-point spread on the weeklies. In 2021, I had 74 trades. Using this formula where you take the profitable percent times the reward minus the losing percent times the risk times the trade size. Well, the trade size is going to be less than the $1,000 because I've got a combination of $1,000 monthly leaps and $500 weeklies. The average is going to be about 777. We are correct, and I've been publicly releasing alerts for greater than 10 years. Well, it's greater than 11 years now. We average about 75%. Okay, remember Warren Buffett and Peter Lynch are talking about 60%. You can be a winner. We're 75%, which is kind of unheard of in the industry. However, we cut our losses short. When we make a gain, it's right around 9% of margin. When we have a loser, I cut it about 6% of margin. So I've got more winners than losers, and I make more than I lose. On the average, bringing in about $37.30 per trade. All right, 74 trades a year brings in $2,759 on one contract. Okay, and that's 28%. 28% return on the SPY versus 13.2 for the SPY, and this was a good year. This was a good year. The beauty of this strategy, it's not a home run strategy, okay? But the risk is less. It's conservative strategy. It just brings in consistent money month after month after month. Yeah, we have some losing streaks, we have some losers, but consistent equity curve, and you just continue to do this, and it just brings in money. It's a beautiful, beautiful strategy. The advantages of a vertical credit spread, I go over this many times, but it's great returns coupled with a high probability of success. Yields monthly income on a consistent basis. You're actually selling premium. When we sell a vertical, we are basically the house, okay? And the people that are buying these are the people coming into the casino. We're the casino, all right? Time is our friend. The longer we're in a trade, the time value off of that premium decays, okay? The beauty of credit spreads is you don't have to constantly watch the market. It's a low anxiety, and you have a protection against loss, because when we sell a contract, we buy one further out of the money for protection. Now, this is an example of a bull put spread we put on the S&P 500. We were only in for a short time here. We sold the 19 November for $50.80. Bought it for $49.40 for a net credit of $1.40. And a lot of people say, well, why didn't you just sell this? Well, that's called selling naked. Okay. And the floor traders and the brokers are going to require a lot of margin. They're going to require a lot of years of experience. This is a high risk trade, and the return on margin is better using a credit spread and having protection. Okay, so we got $1.40, and we got out. We don't take it all the way to expiration. We got out at 60 cents. Okay, and that gave us an 80 cents profit in and out, $80 in one contract, and that's 57.2% of the total potential we could have had. 800 for 10 contracts, and I usually trade multiples of 10. Once again, past performance, no guarantee of future results. But take a look at this chart. The S&P 500 came down and hit below the -2 on the regression channel. The three things that I really focus on is the regression channel, the measured moves, and the Fibonacci's. The regression channel pretty much tells you that this is oversold, and it's time for the price to revert back to the mean. And it does come up here, comes back down, and it makes a measured move right here. Measured move is a higher low and a higher high. This is a classic definition of an uptrend. This is your entry point right here. When it comes up here, and once you have a measure move, you can put it on a Fibonacci of 127, comes up to the +2 on the regression channel. Time to take profit. How many days were we in? Half a day here, 2, 3, 4, 5, and we're out. We're out. Okay. Now, this is an email. I send out both text and emails. This is just an email showing you, what I did. I talk about I am entering a bull put on the SPX. I show you exactly how to set it up at a credit of approximately that. Review the trade before executing, modify if you need be. That was my entry. That's my entry email. I send both email and text. I just show you an example of the text then to exit. You can see this is time dated at Wednesday, October 20th, where we got out at a debit of approximately 60 cents. So if I go back in here, you can see that we got in at $1.40 right here. We exited right here on the 20th with 60 cents worth of debit to get us our nice little profit. This is the equity curve for this strategy since 2019. And I've been doing this for, like I said, about 11 years now, releasing alerts to the public. This is just it shows the equity curve. Yeah, we have losers. We have losers. We have losing streaks. But in the long run, we have a very positive equity curve. And that's what you want. That's the kind of trading strategy you want to have. I've been teaching this for a long time. I want to teach it to everybody. This is a rock solid strategy. This is how you make money in the market. I've been doing this for 4 decades. What I'd like you to do is I'd like you to become a member. Learn how to do this. Learn from me, and earn while you're learning. The strategy is really simple. I like to keep it simple, but it takes a while to master it. So if you become a member with me for 3 months, I'm going to give you the 4th month for free. So I hope everybody goes to www.optionsinfinity.com, become a member, And you know, I'd love to teach you this strategy and to make money on a consistent basis. I hope you enjoyed this video. I've got another video here that will be helpful, how I turned 25,000 into $250,000, and that would be very helpful using credit spreads. I'd also like you to click the button over here and become a subscriber to my YouTube channel on let's see, it was the 1st of April. I put out I just started putting out an alert when I see that the market is changing direction. On April 1st, I put out a YouTube. It's there for you to view, saying it's time to get out. It's time to the market's going to drop. And sure enough, the market has dropped. You know, as of today's date, today is the 26th of April, and it's been down ever since then. And when I see a turn in the market, I'm going to be releasing these. So, you know, if you're a subscriber, you will just get a notification that, hey, Dale's put on another YouTube. You might want to take a look at it. Once again, thanks for joining me, and we will talk to you later. Bye-bye now.